What if I told you the internet, the tool you're reusing right now, nearly died before it was born? What if the real story of the early 2000s dot-com crash isn't about failed startups or bad business models, but about a $5 trillion Wall Street experiment that pushed the global economy to the edge and almost wiped out the digital revolution itself? You see, behind every success story, from Yahoo to Pets, there was a hidden web of leveraged money, complex derivatives, and venture capital schemes built on illusions. Money wasn't flowing into innovation. It was being cycled through speculative contracts designed to inflate and then detonate the market on command. When the bubble burst in 2000, trillions vanished. But what most people never learned is that this collapse didn't just crash stock portfolios. It almost collapsed the internet's physical network. Fiber lines went dark. Servers went bankrupt, data centers went silent, and the same players who built the illusion walked away richer than ever. So before we expose how Wall Street nearly killed the internet, tell me in the comments, where are you watching from? And don't forget to subscribe, because this is the unfiltered truth they've buried for 25 years, the late 1990s, the dawn of the new economy. America was hypnotized. Every week, another startup IPO'd on NASDAQ and doubled overnight. Ordinary people became day traders. College kids built websites that supposedly changed the world. Newspapers screamed, "The internet is the future." And it was, but not the way they told you. The official story says it was just irrational exuberance, too much optimism, too much speculation. But what if it wasn't random? What if it was engineered? In 1996, the Federal Reserve under Alan Greenspan quietly loosened margin requirements, allowing unprecedented leverage. Suddenly, Wall Street could borrow 20 or even 30 times its own capital to pour into tech stocks. Sound familiar? The venture capital world went wild. Firms like Kleiner Perkins and Sequoia raised billion-dollar funds overnight. But they weren't investing in sustainable businesses. They were buying narratives. Companies with no revenue were given billion-dollar valuations. Everyone said it didn't matter because this time was different. Sound familiar? By 1999, the NASDAQ had risen 400% in just 4 years. Mutual funds and pensions poured in. Then came the synthetics, Wall Street's secret weapon. Investment banks began packaging tech stocks into exotic derivative products, index futures, options bundles, and internet exposure notes. These were sold to pension funds, insurance companies, and foreign investors as safe bets on the future, but they weren't safe. They were ticking bombs. When the bubble burst in March 2000, over $5 trillion in paper wealth vanished in less than 2 years. Over 50% of tech companies went bankrupt. The NASDAQ fell 78% from its peak. Sound familiar? But here's what they never told you. This wasn't just a financial correction. This was a systemic detonation. Telecom companies that built the internet's physical wiring went bankrupt overnight. WorldCom, Global Crossing, 360 networks. Together, they controlled nearly 70% of the world's internet backbone. When they fell, data traffic was rerouted, delayed, or shut off. Entire web regions flickered like dying stars. Engineers described it as the internet's silent blackout. Behind the chaos, the same Wall Street banks that had financed their debt using derivative swaps, they had turned the internet's infrastructure into a speculative asset, and when it all burned down, they bought the wreckage for pennies on the dollar. Here's where the story gets darker. Most people think the dot-com crash was about hype, websites selling dog food or sock puppets. But that was just the smokescreen. The real explosion came from something most people never saw: fiber swaps. In the late 90s, telecom companies started trading unused fiber optic capacity, dark fiber, as if it were currency. They booked it as revenue, even though it was just swapping empty cables with each other. Wall Street loved it. Every swap inflated valuations, which inflated stock prices, which justified more loans. It was a self-feeding loop of illusion, a derivative of reality itself. The accounting looked like profit, but the profit didn't exist. When the bubble popped, these companies couldn't service their massive debt, and the entire internet backbone teetered on the edge of collapse. This wasn't a few bad actors, it was systemic. The same too-big-to-fail banks that would later fuel the 2008 crisis were the puppet masters even then: Goldman Sachs, J.P. Morgan, Morgan Stanley. They had created an invisible pyramid built on tech optimism and derivative fantasy, and the name of the man who gave them cover, who signed off on the accounting tricks that made it all possible. You won't believe it when you see the receipt. It's even wilder than you think. Let's decode how a $5 trillion illusion nearly deleted the digital age. It all began with derivative leverage. Back in the late 90s, Wall Street went wild. They cooked up brand new financial products with seductive names like Internet-linked equity swaps and telecom bond derivatives. What were they? Essentially promises. Promises to pay based on the future value of Internet traffic. Think about that for a second. They were literally selling futures on bandwidth that didn't even exist yet. Here's how the scheme worked. Banks would lend billions to telecom companies to build out the new fiber optic superhighways. But then, in a classic Wall Street move, they'd slice and dice that debt, repackage it using derivatives and sell it off as super safe income products. And who bought this stuff? Pension funds, your retirement money. They were told they were investing in the infrastructure of tomorrow, but it was all built on a mathematical fantasy. By 2001, the total paper value of all these telecom and internet derivatives ballooned to over $5 trillion. $5 trillion. Meanwhile, the actual revenue generated from all those brand new fiber networks was less than $300 billion. That's a leverage ratio of nearly 17-1. It was a house of cards waiting for a slight breeze. The deception went even deeper. Accounting rules at the time were so lax they allowed something called capacity swaps. Companies could trade network capacity with each other and book the entire value as immediate revenue. It was like two broke people swapping IOUs and both claiming they were rich. Companies like Global Crossing reported massive profits on paper while they were actually hemorrhaging cash, burning through billions. Then came the reckoning. When a few sharp analysts finally looked past the smoke and mirrors and realized the fraud, the entire system didn't just crack, it shattered overnight. The Nasdaq lost $2.7 trillion in market value in just 6 months. 1.7 million jobs in the US tech sector simply vanished. Over 95% of internet startups went belly up, their dreams turning to digital dust. The bankruptcy of Global Crossing alone vaporized $25 billion in equity. And behind the scenes, it was even worse than the headlines suggested. Remember WorldCom? They were the second largest long-distance phone company in America. They used those same capacity swaps to inflate their earnings by $11 billion. When WorldCom imploded in 2002, it triggered a financial contagion, a credit crisis that almost brought down the very banks that had financed the whole charade. J.P. Morgan, Citigroup, Bank of America. They all had to quietly write off billions and billions in bad telecom derivatives, hoping nobody would notice the scale of their blunder. But this crash wasn't just about stocks and balance sheets. It erased actual infrastructure. Data centers went dark. Web hosting companies collapsed. Millions of websites, personal blogs, early online communities, they just disappeared overnight. The internet as a functioning global network was one financial crisis away from ceasing to exist. We were inches from a digital dark age. Now, here's the truly sinister part of the story. The bubble's collapse wasn't just an accident. For some, it was a planned demolition, a harvest. While regular folks, pension funds, and small-time investors were completely wiped out, the Wall Street insiders who had hyped these stocks began to short them. They bet against the very companies they had just promoted. Hedge funds like Tiger Management and Soros Fund Management made billions of dollars betting on the crash. They engineered the bubble, then profited from its burst. They crashed the market, and then they bought the ruins for pennies on the dollar. Giants like Verizon and AT&T, backed by Wall Street capital, swooped in and purchased the bankrupt fiber networks for a fraction of their original cost. And who rose from those ashes? Google and Amazon. The cost of bandwidth, the very thing that was once speculated into oblivion, had collapsed by 99%. The implosion of the bubble became the foundation of their empires. And who was the master of ceremonies for this entire fiasco? Alan Greenspan, the chairman of the Federal Reserve. He championed financial innovation and staunchly refused to regulate the derivatives market that fueled the fire. When it all came crashing down, he dismissed it as a necessary correction. But behind closed doors, the Fed was secretly pumping emergency liquidity into the banks to prevent a total systemic meltdown, to keep the lights of the internet on. The internet as we know it survived by a thread. So fast forward to today, does any of this sound familiar? It should. We're repeating the exact same playbook, only this time the scale is infinitely larger. The dot-com bubble was just the prototype. The rehearsal for the modern AI, crypto and data economy. Venture capital funds are once again inflating valuations to astronomical levels. Tech companies are again using complex, synthetic financial products to represent value. But instead of bandwidth futures, this time it's AI compute leases, data derivatives and tokenized assets. Just like in 2000, the numbers simply don't add up. Nvidia's valuation has soared past $2 trillion, more than the entire GDP of Italy, based on projections of future AI demand. The crypto market peaked at over $3 trillion in 2021, a universe of assets with little to no intrinsic value. And who's bankrolling this new boom? The same names: Goldman Sachs, BlackRock, JP Morgan. The illusion never ended. It just evolved. The $5 trillion dot-com bubble was the first live-fire exercise of the digital Ponzi economy, a system that merges technological hype with financial speculation. We didn't learn from it. We digitized it. Here is the truth most people never hear. The dot-com bubble didn't just crash the market. It fundamentally changed the internet's DNA. It was the proof of concept. It proved that any digital innovation, no matter how revolutionary or noble its intentions, could be turned into a speculative asset, leveraged and weaponized. The internet of today isn't the open, decentralized frontier it was promised to be. It's a privatized network owned and controlled by the very same financial giants that nearly destroyed it 25 years ago. Every click you make, every search you type, every byte of data you generate, it's all monetized through a shadow world of derivatives, algorithms, and high-frequency trades. AI, crypto, cloud computing, it's all built on the same shaky scaffolding of synthetic value. And when this new bigger bubble pops, because all bubbles eventually pop, it won't just be stocks that crash. It will hit your job, your bank account, and your digital identity. Because this time, the internet isn't just part of the economy. The internet is the economy. That $5 trillion that almost killed the internet wasn't just a historical event, it was a warning. But we mistook it for ancient history. Now, we're living in its sequel, and the stakes are 1,000 times higher. If you've watched this far, I want to know where you're watching from. Drop a comment below, and make sure you subscribe, because the next collapse won't come with a warning bell. We built our entire digital world on borrowed time. The only real question left is, are we any wiser now, or are we just walking the same path in better suits? Thanks for watching.